Hi there guys, this is FS Coach Your Mentor. Welcome back to another lesson. For those who have reached this far into the course guys, I'd like to give you guys a thumbs up. So without any further waste of time, let's start the lesson. So firstly guys, before I start the lesson, I'd like to first introduce myself. For those who don't know me, I am Thapelo Mavitsela. On Instagram, I am known by Thapelo_gold. And about me, I'm actually a third year student of FA South Africa. I didn't finish my studies. And I have 6 years trading experience, guys. I've actually been trading for the past 6 years. We usually started on the year 2017. And I'm also the founder and the director at the FX Gold company, guys. And I'm definitely sure you've been enjoying the lessons so far. So I'll be covering strategies and trade management skills. Okay, guys? So without any further waste of time, let's continue with the lesson. Now with our lesson guys, we are going to start with the ultimate guide to trading. The reason I'm going to cover these guys is because a lot of newbies or a lot of people who are new into the market, they are basically struggling in terms of what to do in the Forex market, on how to be consistently profitable in the Forex market, because most of you guys actually have a problem of blowing accounts. So we're going to start with what? 3 techniques for risk management in trading. This lesson guys, we're basically going to talk about risk management and how you can apply it properly in your trades. Risk management is the foundation of a successful trading system. We can basically break risk management into 3 categories. So now I'm going to dive in deeper to explain to you guys how to properly understand risk management and how to properly apply it in your trades. We're going to start with the first one being risk protection. Most of you guys might wonder, what is risk protection? When it comes to risk protection, guys, this one will specify in terms of what you're protecting your account against and how are you going to basically survive having a real life trading account. And secondly, I'm going to cover risk profile. Under risk profile, I'm going to explain what kind of risk you need to input in your trading account when you're trading a real account, and also how to make sure that you actually survive longer in the trading game. And the last one is active trade management. With this one, I'll basically explain on what to do when you have an open trade on your live account and how to go about making sure that you're not doing the wrong things when you have trades open in your account. So let's continue with the lesson, guys. Number 1, risk protection. Risk protection is an introduction to risk management, meaning that trading Forex includes technical analysis, good strategies, and proper psychology. These are all necessary, but alone they are not enough to make you a successful trader, guys. In order to protect your account against something, it is necessary to begin with an understanding of what is it that you are protecting yourself against, which is what I explained, guys. When it comes to risk protection, most of you guys don't even know why you need protection. How will you be able to survive longer in the game if you don't even know how to protect yourself when you are actually in the jungle of trading? So it is fine to say that protection is being taken against potential loss. Yes, guys, losses are an inevitable part of the trading game. We need to accept losses as the cost of doing business. Even the world's best traders lose sometimes. What we need to learn is how to handle losses. Highlight the fact that you need to know what is the protection. What is it that you need to protect yourself from? One of the biggest major things that affect many traders is losses, guys. As long as you don't know how to protect yourself from losses, because losses are natively part of trading, you can't act like you won't have losses. So if you know losses are part of trading, how can you then protect yourself in the midst of it all? This is what exactly it means to have risk protection. You have to know that as a trader, losses are part of trading. Losses are the cost of business if you're doing trading. So you have to learn on making sure that you can have losses, but you're able to protect yourself from blowing your accounts. You can have a loss, but it doesn't mean that it should be the end of your trading journey. Okay, let's continue with the lesson. What is Forex risk management? All right, Forex risk management comprises individual actions that allow traders to protect against the downside of a trade. More risk means higher chance of sizable returns, but also a greater chance of a significant loss. Exactly, guys. When sometimes you are trading Forex, you are actually facing a downside of a trade, meaning that your trade is not going in your favor. It means that if you have a higher risk and it goes against your favor, it will lead you into a significantly greater loss. Because of the risk you applied, you're trying to make only profits, not understanding that losses are part of Forex. So every time you take a trade, you have to have the mentality of knowing that losses can eventually happen even from your best trade. Guys, One of the best quotes that I've had in the trading industry, guys, is that your best trade can turn into your worst nightmare. So make sure that you don't fall into the wrong side when a trade is going against you. Let me continue. Therefore, being able to manage the level of risk to minimize loss while maximizing gains is a key skill for any trader to have. Exactly, guys. As a trader, you need to be able to manage the level of risk to minimize your loss. As long as you don't know how to control that, even if you are a great trader, when you have the worst trade that day and basically you've went all out on your risk, you will eventually lose. Okay? The underlying root cause of a loss in any particular trading situation is the trader's own fear and greed, which is emotions, guys. Exactly. When we face losses as traders, that tends to activate or trigger our emotional side. Because why? Forex trading is very much psychological, and many people don't realize the power of psychology in the industry, guys. Most people are only focusing on the technical side, which is the analyzing side. But what you need to mostly understand to be a profitable trader, guys, you need to be able to control your emotions, especially with your enemy, which is losses. Okay? So how it affects our trading. So basically, I'm going to explain on how fear and greed affect our trading journey. The fear of a missed opportunity may result in a premature trade. Because you have missed an opportunity, you feel like you've missed out on a chance that you would have made a lot of money on. You end up taking a trade that is not even ready, a trade that is not even mature. Because why? You have a fear of missing out. That is also one of the triggers that emotions cause in terms of affecting you as a trader. So what most of us do when we're so afraid of missing a profit, that we tend to constantly trade too often, which is fear of missing out. Exactly, guys. After you've missed out one of your best trades, let's say you've been analyzing for a week and you haven't had a chance to actually trade, but now you finally have your real account and then you feel like you've missed a trade, you end up taking trades that are not high probability, but trades that are most likely to lead you into losses. Okay? So a much bigger problem, however, is that the judgment upon which the trade is based may be invalid because that opportunity has not had a chance to fully develop. That means something could go wrong. If it does, the position will probably be stopped out. Exactly, guys. After you've actually had a fear of missing out, a bigger problem that you will face will be having judgment based on the trade that you took, which might be invalidated, guys. Every time you take a trade, the only judgment should be from the fact that your trade is invalid, and then you should close it, because if you don't close that trade, that means it will go even worse against your favor and eventually blow your account. So you need to learn on how to control emotions, because those are the key things that affect us as traders, right? So now you're wondering how to prevent fear of missing out or missing an opportunity. So basically, I'll now explain, guys, on how to make sure this current emotion doesn't affect you as a trader. Protection against the fear of missing an opportunity is discipline and confidence in your trading strategy. As long as you have a trading plan, you have discipline, and you have confidence, you will not have any fears of missing out, because you know if you missed a possible chance, you are not worried, because according to your plan, you only trade opportunities that are highly probable and also are matured. Okay, so let's continue with the lesson. So yeah, guys, on these slides I will cover 4 steps for disciplined trading, right? Let me start with the first one. Number 1, take direction from the market, not from your hopes, greed, or fear. Most traders do not see the market clearly, so you need to control your beliefs about the market. Exactly, guys. When it comes to the Forex market, never take a trade and actually hope and pray this one trade will save my life. Not one trade. There is no such thing as one trade will save your life, guys. That is a gambler. Whoever says that is giving you bad knowledge. That is a gambler's perspective, guys. You can only depend on one trade. You must have a series of trades that lead you to your profitable journey. You have to know that slow and steady leads you to the goal, right? Number 2, predefine your risk before taking a trade. I told you this one I'm actually going to cover under the risk profile. As long as you know what kind of risk you're putting in a trade, then you are able to know that you're surviving the loss, then you can possibly take the profit. As long as you know that you can survive the loss, then you can go with the profit. But as long as you want to make too much profit and not be able to survive the loss, then that is a bad trade. Number 3, cut your losses without hesitation when the setup got invalidated, guys. Exactly, guys. Some people don't prefer trading with a stop loss because they're trying to basically avoid having a lot of stop loss hunts, because the market currently is very choppy, especially this year, 2022. The market has been very, very choppy. So a lot of people get stopped out and then the market goes in their favor. If you are manually trading, you have to know that, guys. You have to set an area or a boundary whereby you're saying, if the market crosses so and so line, you are actually done trading. You have to then, without hesitation, close that invalidated trade. Number 4, use a systematic money management plan. What this means is that as long as you have a system that you're going to apply in your trades, then you'll basically have the results of that system. But as long as you enter in the trading industry without having any plan, just entering the market with the hopes of making money, then that will lead you to losses, guys. Okay? Now let's cover chapter 2, guys, which is what? Risk profile. Risk profile, before I even start the chapter, I'm going to tell you guys what it actually means. What kind of risk are you putting on your account size? And if you're putting that risk, do you understand the capabilities of that risk? Can you survive the loss of that risk? If you can survive the loss, then yes, you can take the profit. So let's continue. Over the years, we have found that the most generally accepted profit risk ratio is 3:1. Most of the time, we always use 1:2 risk ratio, but the most generally accepted profit risk ratio is 3:1. First of all, it prevents a major loss. It also gives the trader some breathing room. It is unreasonable to assume that every trade will be caught exactly at a sniper entry point, guys. Exactly. Having a 3:1 profit risk ratio means that if you're going to take one major loss, you're going to actually take profit 3 times based on that very same entry. So this is what it means, guys. We're going to cover it as we go along with the course, guys. We're going to dive in deeper in terms of how to apply it properly, the profit risk ratio in the market. A long position may move somewhat lower before it turns up, and a short position may move somewhat higher before it turns down. This is what we call market volatility, guys. In 2022, the market is highly volatile, and most of the trades that you take might first start going against your direction before going into your favor. You have to allow the market to move and build your patience in this trading game, because no one can control the volatility of the market. If you've taken a trade and it's not going in your favor, it doesn't mean that it might end up against your favor. As long as you give the market enough room, you have your stop loss and take profit target, you leave the market to run, it will end where it ends, as an exit point. A worst trade can turn into the best trade, and the best trade can turn into your worst trade. Always keep that in mind when you are a trader. Risk management in trading could be a deciding factor in whether you are a consistently profitable trader or a losing trader. Remember, you can have the best trading strategy in the world, but without proper risk management, you won't be successful in trading. Exactly, guys. It doesn't matter if you are the best trader. As long as you don't know how to apply risk, your worst day will come. That day whereby you take a wrong trade, that trade will blow your whole account. So make sure you know how to apply risk. You know that you have to protect yourself against losses and stay focused on the goal. Let's continue with the lesson. Now let me dive deeper in risk to reward ratio, guys. What does the risk or reward ratio tell you? The risk or reward ratio helps traders manage their risk of losing money on trades. Even if a trader has some profitable trades, they will lose money over time if their win rate is below 50%. Meaning, guys, if you always have major big loss targets but small take profit targets, eventually you will lead into losses, because your graph won't be going up because of the losses. As long as you have major losses, your graph will be going down, meaning that your trading journey will actually go towards the downside. You will eventually lose because your winners are smaller than your losses. The risk or reward ratio measures the difference between a trade entry point to a stop loss or take profit point. Comparing these two provides the ratio of profit to loss or reward to risk. Exactly, guys. As long as you are able to set your targets properly, you will eventually become a winner. As long as your take profit targets are much higher than your stop loss targets, eventually you will have success in the industry. Let's continue with the lesson. To be successful in trading, we must have a trading method with an edge. Learn to stick to your risk to reward ratio, and eventually you will master how to approach trades with the right mindset and correct risk appetite. Exactly, guys. To be successful in trading, you must have a trading method, guys. You must have a systematic approach you must have a trading plan and have an edge. As long as you are able to make sure that your risk to reward is more on your side, your risk to reward is more on the profit side, then that is an edge over the market. Learn to stick to your risk to reward, and eventually you will master how to approach trade with the right mindset, guys. That is what it's all about, guys. Trading most of the time is about the mindset. A lot of people are misunderstanding on how big trading is psychologically, guys. Most of the things you don't know how to apply them properly because of psychology. Ignoring the results of individual trades to win. So now, guys, I'm going to give you a perspective and a mindset of a real trader. As a real trader or professional trader, you must understand that ignoring the results of individual trades to win, this is not possible without total trust in your methods. As long as you trust in your method, one loss doesn't mean it's the end of the journey. You know that losses are cost of the business. If you have confidence in your trading method, losses shouldn't worry you at all. Just take it and move on. Successful trading is not totally avoiding losses, but winning more than what you lose. Exactly what I explained, guys. For every trade we enter, there could be 4 outcomes. Number 1, a big loss, a small win, and a big win. We have to make sure that we remove the big loss. Let us remove the big loss from this. Small wins will take care of small losses, and big wins will remain with us. Ensure that your trading plan eliminates the possibility of losing big. You can't make money if you are not willing to lose. It's like breathing in but not willing to breathe out. It's very important for you guys to know that losses are part of the industry, and we have to somewhat find a way to live within the losses. As long as you don't have a big loss in your trading, then you are bound to be successful in the trading industry. So now, guys, I'm gonna cover the last chapter, which is active trade management. On this one, guys, I'm going to explain how you manage your trade when it's active. Before entry, you must know where buyers in an uptrend and sellers in a downtrend enter. Okay, guys, basically when it comes to an active trade management, it's also important for you guys to understand when do you enter your trades. Is it a high probability, a low probability, or a medium probability? Let me explain using a bullish trend. Let's say we're at the end of a corrective move, then you can buy with small risk and exit when you know that this is the end of the impulsive correction. So guys, what this means is that, guys, when we have a bullish trend, we know that in a bullish trend, impulse move is actually a buy and a correction is a sell, because we know that an impulse move is the overall direction of the trend, meaning that in our bullish trend, we are overall looking for buys, and in a bearish trend, we're overall looking for sells, meaning that our correction in a bullish trend will be a sell. So what this means is that, guys, let's say we are at the end of the corrective move, meaning that we have now went to our support. Our sellers have completed a move. You can now buy with a small risk because you're at a support, and then you're gonna need to exit when we've impulsed back towards the upside and we are then on our resistance. That's points whereby you should know when to enter. You must enter at a support and exit your buy at a resistance. So that's one of the key structures in terms of understanding your approach in trading. For finding sellers in an uptrend or buyers in a downtrend, we have to analyze by weighing the relation of supply and demand of the instrument you want to trade. Exactly what I explained before, guys. It's important for you guys to know when you enter your buys and when you enter your sells. And when you enter your buys, it's also important to know when to exit your buys. And when you enter your sells, you have to know when to exit your sells. So most traders focus too much on the entries, as that's the most hopeful stage of a trade. But the fact is, your exit determines your profit or loss, guys, not your entry. You can have a good trading entry, but if you manage your trade poorly and exit at the worst possible time, you can still end up with a loss. Exactly what I explained before when I started this lesson, guys. I said that your best trade can turn into your worst nightmare. As long as you don't know which point did you mark as an area whereby you're saying this will invalidate my trade, then that trade can become your worst nightmare, guys. So it's very important for you guys to know when you have an active trade, how to approach it properly. So guys, I'm basically gonna dive in deeper on the following lesson, explain to you guys on how to properly master active trade management. This is just a thorough scope and a thorough understanding of what we're gonna do on how to approach proper risk management as traders. Because we know for a fact, guys, as long as you want to be part of the trader, you have to understand that losses are part of the game, and how to survive with them is a key ingredient to being successful. So guys, hopefully you enjoyed the lesson. See you guys on the next lesson. If it's good, your mentor, signing out.